So today's lesson, because we have 2 hours together, is going to be 311 and 312. So you probably already started with FRQ 2012, question number 3. Once you are done with that, then we're going to do this lesson, 311, on deficits and debt, and then you'll do 312 on the Phillips curve, and end with a Socrative quiz. The Unit 3 review is due tonight, so if you have extra time in the 2-hour time period, you should use the time to work on the Unit 3 review. Okay, so first of all, we're going to talk about deficits and debt. What is the difference between a deficit and a debt? We've used these terms a lot already. Deficit is an annual measure, which means it's calculated each year. And what we do is we compare tax revenues to government expenditures. If those two things are equal, there's no deficit. If government expenditures exceed the tax revenues, then we have a deficit. If it's the opposite, of course, if we collect more in taxes than we spend, then we run a surplus. That's a flow measure, and it's calculated every year. The debt is the total amount owed by the national government to all of its lenders, right? And that's how we finance the accumulated annual deficits. We're borrowing money from lenders. So that amount gets accumulated year after year. So let's say we had a very simple, like one year we had a deficit, and the next year we had a deficit, and the next year we had a surplus, and the next year we had a deficit. You'd add all those up to calculate the debt. So it'd be negative 25, negative 15, negative 20. You would have an accumulated debt of negative 20. And of course, it would be adjusted for whatever you had paid down, because we do actually pay back on the debt every year. But they're different concepts. We might have a surplus in a year. We will still have the national debt. Deficits, as we know, tend to rise during recessions, and they rise for two reasons. One, because of the automatic stabilizers that you learned about last Friday, and one, because of the discretionary stabilizers, or the fiscal policies that we tend to use during recessions. And so you can see the deficit as a percentage of GDP over time. During really good economic times like this, right, then we actually have a surplus. And the surplus would be shown here as a negative deficit. But during recessions, right, then we're going to run high deficits, partly because of automatic things like we're collecting less in tax revenue, we're paying more for unemployment, but also because we'll use intentional fiscal policy. So we're going to analyze that a little bit further, the fact that some of the deficit's intentional and some is due to these automatic stabilizers. If you look at this particular graph, and I'm going to ask you to ignore the numbers on GDP here because they're not really relevant. If you think about it, government spending is a fixed amount. The Congress debates and the president approves, right, and we get a certain budget for the government. And so that is expressed here as a horizontal line because it is determined by government approval. And let's just say, for the sake of argument, that we set on a $100 million budget, or $100 million of government spending. In order to collect the tax revenues, we can't just say, oh, and we'll collect $100 million in taxes. We estimate how much we're going to collect in taxes based on what we think the GDP will be. So we set the tax rates, right, and we hope that the GDP will be where we expect it to be, so tax rates will generate $100 million worth of taxes. So this tax line is based on the rate, and the rate, what tax revenue is produced depends on how much income people actually earn. So if we end up falling short of that, if we end up having a recession, right, because our GDP is over here and it's less than our full employment GDP or our expected GDP, then we will automatically have a deficit. This is not an intentional fiscal policy. We automatically have a deficit here because our tax revenues fall. Even though we're using the same tax rate, our tax revenues fall and our government spending increases because of things like unemployment benefits. Okay, if on the other hand we end up exceeding our GDP, we end up over here, right, in a period of expansion, then we're actually going to generate an automatic surplus. And that's going to happen because in a period of inflation or a really rapid expansion, we're going to have our tax revenues go up and our government spending will decrease because fewer people will be getting unemployment, fewer people will be getting food stamps and other sorts of automatic stabilizers. So these kinds of deficits and surpluses occur thanks to our automatic stabilizers. Okay, so what this is showing us is basically the same thing. So assume that the economy, if it were at full employment, it would be generating $500 billion worth of taxes, which would match the $500 billion worth of government spending. But if we end up in a recession in year 2, right, then we have this deficit created. So this is an automatic deficit. But the next slide is going to show us what happens when we put a fiscal policy in place on top of that. And unfortunately, all the letters change, so it's kind of a stupid way of illustrating this, right? But imagine that this was our original line right here, okay? And we're in a recession now, so we have this deficit because of the falling GDP, okay? The reduction in GDP and the recession caused this deficit. And then our response to that deficit is, oh, let's cut taxes. So we cut taxes, we shift this tax line down because now, no matter what the GDP is, we're going to be collecting less in taxes, right? And so now on top of that automatic deficit, we now have this discretionary or intentional deficit as well. Now, if we somehow were to return to full employment, we'd still have a deficit because our tax rates are not high enough to capture enough tax revenue even at full employment. So now let's imagine we end up back here at QF again, okay? Wow, we still have a deficit, right? That's what we call a full employment deficit. So full employment deficits occur when we have an intentional fiscal policy driven deficit, when we actually have a budget that we have intentionally passed where our government expenditures are going to exceed the taxes. When we have an automatic deficit, it's just happening during a recession just because we're not generating enough tax revenue or we're spending too much. If you look at this interesting little table, it calculates for you actual deficits or surpluses and full employment deficits or surpluses over a long period of time. You can see they're generally the same direction, but it's kind of interesting because when you get to 1998, you can see, right, that we ran an actual surplus, right, while we were still running a full employment deficit. So we were actually intentionally collecting too little in taxes, but we ran a surplus, okay? So somebody went like, hey, wait a second, we're actually in a period of expansion. We do not need to have an expansionary fiscal policy anymore. So the very next year, you can see that we switched over to a full employment surplus, right? We started actually, we didn't just balance the budget, we actually started collecting more taxes than we needed to try to slow the economy down a little bit, which is why you see surpluses in those next few years. But to refer back to the beginning, we still have the national debt. Those surpluses were not enough to pay down the national debt. And if you look at this, this is just another way of looking at that. This is from our textbook now. Just the same thing, it's just comparing actual deficits and what they call cyclically adjusted deficits. And that's where they're saying, is there an intentional deficit and how much is unintentional? Okay. So, should we be worried about all these debts? First of all, there's crowding out, right? So potentially, this debt could actually crowd out private investment spending, and investment spending is important because it builds capital, builds potential GDP, and leads to long-term growth. So yes, there's certainly concern about crowding out. It also puts financial pressure on future budgets because it captures our future spending. It says, we're going to commit, 5 or 10% of our budget to paying off our current debt well into the future, right? So future Americans will have to pay a lot more in taxes just to be able to pay back the money that we borrowed. There's also concern about financial leverage. Could a country like China that owes a lot of our debt use that in some way as a tool to try to pressure us, for example, not to try to call them on human rights violations? The biggest fear, of course, is default, the idea that we wouldn't pay back our debt, and then people would stop lending to us. And then we would really we'd just have to stop spending on things, primarily the military, because that's our biggest expenditure item, or on Social Security, or we'd really have to raise taxes dramatically. And then there's the implicit liabilities, and that just means we have, liabilities are like promises to pay, and we have made promises to pay well into the future on, in particular, Medicare, Medicaid, and Social Security. And if you look at this, this shows you, basically where we're at now, right, around here, okay, in terms of the spending, the percentage of our GDP that is going to be spent on Social Security, which is about this much, and how much of it is going to Medicare and Medicaid. But if things continue as they are, you can see that medical care for the elderly and for poor people is going to consume a bigger and bigger portion of our GDP. And that is very difficult because that will definitely crowd out some private investment. So the biggest concern about the deficit isn't necessarily where it's at now, but what's coming in the future. So I'm going to have you, in a minute, look at this free response question and answer it. And then the actual scoring rubric will be on the Moodle site for you, so you can check your own answer. But it's just another good one to help you think about how these changes affect real GDP and price level. This will not be collected. And the other thing that I want you to do in just a moment is I want you to look at these three sources that give a lot of different ways of looking at a lot of numbers and some graphics to look at the debt. And then there's a question, there's a Google Forms question for you to answer this on the Moodle site. So that is the conclusion of deficits and debt. After you have done the free response question and checked it, and checked out those sites and answered the Google questions, then you should go on to the next lesson, 312.